Hey guys, welcome to this week's show. This week we're looking at the contentious subject of the US election. Not the result, but what you need to be doing with your portfolios to protect yourself and profit from this known but very uncertain event. Certainly plenty of new things for you in terms of the way that as a professional we're approaching this, and hopefully plenty in there that's going to help you protect your wealth and set yourself up for the aftermath, irrespective of whether it's a blue or red wig. See you in the show. Hey there guys, welcome to this week's Money and Investing Show with me, your host Andrew Baxter, and as always my faithful companion and offsider, Mr. Mitchell Laurential.
Faithful I am. I love that introduction, Mr. B. Although you've got that husky voice today, I do need to get your advice on something very, very important, especially as we run into interest rate cuts and the presidential election, and that is how to position your portfolio.
Okay, well it might sound like Marge Simpson by the end of this if my voice gets much more gravelly. Been doing a lot of talking, a lot of interviews over the last couple of days, so we're starting to catch up. How do you position your portfolio? And I think the key thing with this, Mitch, is that these are known events. If we look at markets and investing in general, there are things that are known, that company announcements, interest rate cuts, presidential elections, all of those sorts of things. And then there are unknowns, September 11, Corona, and various things and that thing. So there are how you treat things that are known versus things that are unknown. And for any investor out there, and my bet would be, for most stock market investors that are buy and hold investors, they're looking at this going, oh, it's getting a bit shaky, but we'll ride it out.
And isn't that necessarily the right call?
Definitely not. There's a fairly unambiguous view before we start, because we are in a scenario within markets where things are going to happen. Now, we're not going to talk about the outcome of the US election because we don't know what that's going to be. And one of the big traps that many investors walk into is they think that to be successful as an investor, you've got to be able to predict what's going to happen.
Not true.
Successful investing is actually responding to what's happening, not trying to guess what's going to happen. Okay, so this is a little bit of a reframe for a lot of people on this. So, first things first, we've got the RBA interest rate cut. It's happening on Tuesday, Melbourne Cup Day, and to be perfectly honest, it's already factored into the market as a given. So if it happens, market's already expecting it. If it doesn't happen, I suspect you're going to see a reasonable sell-off in the Australian market.
Sure.
The actual impact of an interest rate cut, I don't think it's going to be that big, because if you have a 0.1% cut in interest rates, so for every 100 grand you've got borrowed, you're $100 a year better off.
So what's that? $2 a week?
$2 a week. Okay, so it's a latte a fortnight better off.
Okay.
Now look, anything is better than nothing.
Sure.
But that's also assuming the banks pass that interest rate cut fully on to borrowers.
And will they necessarily do that?
Probably not. Probably not. And so the notion of what it's going to achieve, I think, is quite mooted. It'll weaken the Aussie dollar. That's good for our exporters, which in the current economy is good. So, that's the interest rate cut. It's almost a formality. You would expect if it doesn't happen, you are going to see our market sell off on the back of that. But to be perfectly frank, that's just like the palate cleanser before the entree, before the main, and the main course, of course, being the US presidential election and the impact that's having on markets.
And that seems to be the talk of the town at the moment, as it should be, because we know what kind of effect it has on volatility and share price movements. I guess it is, as you mentioned, a known event, but the advice would be, how do you actually position yourself around that known event?
Sure, and look, you can't say this one's crept out of left field. It's been 4 years in the making.
Plenty of time to plan.
So, to my mind, and if I may as well talk about how I have my portfolio structured, because that's what I'm doing. So, talk is cheap, but money buys the whiskey. So let's talk about how the portfolio is positioned. Any long positions, I'm hedging, as we put out to our client base this week as well. We've bought puts for protection.
Okay.
What a put is, for those people that aren't familiar, think about insuring your car. Let's say you've insured your car for 60 grand. You've got an insurance policy. Your car gets written off in an accident. It's worthless. Because of that insurance you've got, you can write off to your insurer and get a check for 60 grand to buy another car. Well, you can do exactly the same thing with shares. You can insure your shares for pretty much whatever you want. Let's say Fortescue, you might want to insure it for $19 per share. And if the share price drops to $10, because you've got that insurance policy, we call it a put option in markets, you've got the right to be able to sell your shares for $19 guaranteed. So it's a very effective way of managing risk. And we recommend this frequently with our clients at times of uncertainty, to be able to provide that peace of mind of not waking up tomorrow and seeing the market down 1,200 points and you having a substantial 7-8% removed from your portfolio by that market move. It helps eliminate that. And of course, like insurance, it comes at a cost, but there are ways that you can offset that. We teach that sort of stuff to our clients as we go further in. And I don't want to get too much more into it than that.
Yeah.
But buying insurance, or put options as we call them in the market, on any long position, I think would be extremely prudent going into this time of uncertainty, and that's where we've got our clients, and I've got myself positioned like that. That's as step one.
Okay, so that's the run into. So hedging your long positions. Anything else you recommend in the lead up?
Absolutely. One of the things I've been doing, we've seen, for example, within the Australian market, if you look at look, there are a lot of different names for these things out there. The All Ordinaries is what everyone assumes is the index. It's the ASX 200, the top 200 companies in Australia.
Sure.
It's been pretty range bound between about 58, 5,900 and 6,200 now for about 6 months. And so what I've been doing, I've been using a derivative strategy. It's called an iron condor, either side of that market. And what I'm looking to do is to see the market just stay in that range. So when it's up at 6,200, I set a trap up there that lets me get paid. As it runs down, I keep all of that income from under there. As it hits that sort of low level, 58, 5,900, I put another trap on there that then lets me profit as it starts to recover. So you kind of got some brackets, parentheses, if you will, around the market.
And we teach that throughout our advanced options program, as we know.
We do. So I'm using AP, which is the futures market on the Aussie market. I've got bear call spreads on that, which have been very, very profitable running into this fall away that we've seen in markets. So there are a couple of ways, if you've got an existing portfolio, how to protect it. If you're looking for a more aggressive speculative spin, using spreads can be very, very effective at that, especially on the index. But probably the biggest one mentioned, it's a blind Freddy will tell you that this is what you should do, yet most people out there have got no idea how to do this. And that's why education is such an important thing.
Sure.
And that is that, in this run up to the election, number one, you've got Congress failing to pass any more fiscal stimulus in the US. So
causing a lot of uncertainty.
Causing a lot of uncertainty. Markets hate uncertainty.
Sure.
Then you've got the big day on November the 3rd. And so by definition, markets are going to be more volatile. Now, being volatile doesn't mean it's going up, and it doesn't mean it's going down. It could be doing both, and then that's what volatility is effectively created by. So one of the trades that we've got on, and we've talked to our clients extensively about this, is on something called the VIX index.
It's actually VIX trade.
Yeah, so the VIX is it's known as the misery index for various reasons in colloquial terms. But what the VIX does, the more volatile the market gets, the more the VIX index moves up, reflecting the volatility that's going on. So,
sure. And you can trade that.
You don't need to get direction of the market right, you just need to know it's going to be more volatile. Presidential election, Congress not passing a bill, lots of uncertainty. You would expect the market to be more volatile. So it's a pretty obvious trade.
Why isn't every single person taking a long position on the VIX? It makes total sense, right?
Most people don't even know that it exists. Now they do, but then how do you know, or how do you then get exposure to it? And there are a myriad of ways, and again, we teach that sort of stuff. So we've got long options positions on that. Currently we're up in the order of about 60%.
Wow, great trade.
Based on a known event that's very obvious when you actually break it apart and articulate it. And that's the key thing when, I've spent the last 20 years dedicated to teaching people this kind of thing. When you start to break things apart and lay the components out on the table, it is very obvious. It's not this this huge mystery. Most people look at, it's too hard. Don't know where to start. Complicated, jargon, don't have enough money, all these different things. But when you actually start to break it down into component parts, it's actually surprisingly simple. But so is cooking from a recipe. There's a process to follow. All you gotta do is follow the steps. Don't think too hard, just follow the steps.
Makes sense.
HelloFresh, or Marley Spoon, boom, there you go, there's your 7 steps, is decent food.
Sure.
So VIX trade, great one on there. And look, whether I close that out prior to the election or probably post, I'm minded that I'm probably going to take it through the election.
Sure.
And this is, and I'll explain why in a few moments. So hedging long positions, so all of those people that have got a super portfolio of shares, you need, and you're leaving your run very late for this, probably earlier in the week was the time to be doing this,
sure,
to buy some insurance in case things drop out, because any of those gains that you've seen post the market turning point, March 24, may well be given back.
Sure.
And that can be very, very expensive.
That's scary. It's very scary.
So a little bit of protection, insure your car, insure your shares, get it protected so that you've got that peace of mind. And look, if we're totally wrong on that and the market pushes up, at least you're able to sleep at night, just like you can when you don't have an accident in your car. You don't go moping around going, I didn't make an insurance claim this year. You're happy your car didn't get smashed.
You got to dig the well before you dig the water. And I guess that's a really good segue, AB, into how you're actually going to trade the presidential election after. Because once we know the result, where do you see markets going, say, if Biden wins or if Trump wins? It's a two-horse race, obviously.
Is it? I thought it was Biden and George Bush, basically.
Oh, I just asked Biden. Who depends? I know that.
Okay, so I think a Joe Biden win would be bad for markets for a few reasons, and there's no political bias in this particular statement.
Sure.
Markets hate uncertainty, and a new president, new rules, different tax regime, not necessarily seen as being great for markets. So I would see a Biden win in the short to medium term, not great for equity markets.
Okay.
What does that mean? Well, there are ways you can trade that. We use strategies to profit from falling markets. And these are strategies, you don't need to be some highfalutin floor trader or a hedge fund manager to use. Any mum and dad investor with the right type of account and the right knowledge can actually participate in those trades and give yourself that ability to profit from the fall in market.
Sure.
And anyone that's listening to this going, oh, you know, we're talking about profiting from markets. You know, some people out there doing it really tough, and all you guys talking about money. Look, you need people that are making money to pay tax to support those that aren't working right now. So do your community service, make as much money as you can, so your tax can go towards supporting those people that are on benefit right now.
All right.
So a Biden win I don't see necessarily as being great for markets. A President Trump re-election, a second term, I think you're going to see an enormous amount of civil unrest.
It's a big call.
It's
To what level?
unprecedented.
What, crawling over the White House fence and throwing stones and eggs at the White House?
People climbing over the fence, running across the lawn, the whole 9 yards.
Wow.
I can really see this for a few reasons. Democracy is a wonderful system unless you don't get the result that you want. And we saw in the previous presidential election with President Trump and Hillary Clinton, the backlash and it wasn't fair and there was this and other countries helped and everything else that went along that for the last 3-4 years to try and dethrone and de-seat the president. Again, if you see that happen again, I think given the tension that we've seen in the US and the civil unrest already this year, and unnecessary civil unrest for the wrong reasons. You know, protest, civil rights are one thing, but vandalizing and stealing from stores and things like that—that's a totally different thing. So
sure,
it's a Trojan horse for anarchy. And I think a Trump win, particularly if it's quite close, will kick that off like you've not seen. The National Guard will be out, the whole thing. It'll be pretty gnarly, and that's not great for markets either in the short term. You've got the issue of the new appointment to the Supreme Court. You've got a 4-4 vote at the moment in the state of Delaware on postal votes. And the vote is that if those votes, and Delaware's a very important state, it's a swing state, if those postal votes aren't cast before the cutoff, do we accept them? And the answer should be no. There's a cutoff if they're not received.
That makes total sense.
The Supreme Court is 4-4 at the moment on that. You'd
Yep.
imagine with the new appointee under President Trump's stewardship, that's going to become a 5-4 and will be passed through. So, you know, there's going to be a lot of backlash around that sort of thing too. So I think you've got to prepare yourself for some fairly volatile conditions in markets. Again, if the market's dropping, we've got strategy 1. If it's just volatile, we've got strategy 2. But we are in extraordinary times. I don't think I can recall an election in the Western world that's been so divisive. You know, normally there's a normal distribution where, you know, there are left and right fringes, but most people are somewhere in the middle.
Sure.
Now it's just left and right fringes, and no one in the middle really matters because no one's targeting swing votes.
It doesn't appear like there's any agreement on policy. It's kind of just clown 1 versus clown 2. It's a personality test, right?
Look, it is, and look, I mean, I love the US. I was very close to moving there to live
Sure.
permanently a few years ago, and I love the country. And it's a very, very sad indictment when you have such a great country and you're looking at option A or option B, and that's the best you can put up. And anyone voting for Joe Biden, it's not really a vote for Joe Biden, it's a vote for the vice president. If he gets in, he's going to do about 14, 18 months, health reasons, got to retire, in comes the vice president. And if that's the case, why isn't that person being tabled as the candidate? And there's a lot going on there. It's a very unprecedented time in America. And this is why it's so important to upskill and be prepared for this. All I've talked about is reasonably obvious. Now, I could be totally wrong. It could be a very peaceful election. The result is cast. Everyone goes, okay, well done. You got in. That's it for another 4 years. And let's get back to the business of whatever.
I bet my house that doesn't happen.
No, there's going to be disputes and ballots and postal votes and
civil unrest, protests,
and everything.
Riots.
And that's how contentious this is. And as investors, you can do a couple of things. You can just hold cash, buy cans of tuna fish, go and live in a bunker and wait it out. I've never been a fan of that approach.
No.
Because, you know, there are people out there, you know, there's a couple of US economists that come out here from time to time and call the end of the world and call it a crash in the equity market for the last 15 years. Totally wrong, but everyone remembers they got it right once over the last 15 years.
Sure.
I don't think you need to be buying cans of tuna and bunkering down. I think you need to be proactive. If you've got exposure to that market, hedge it out. If you don't have exposure to that market, or you do, but you want to be more aggressive, use an appropriate strategy that's going to give you some speculative exposure to that. Trade the obvious, which is volatility. It's going to get more volatile, not less volatile as this goes on. And those three planks on the deck are a very, very good way for anybody, you don't need to be the big end of town, anybody to be able to position and be able to profit from what's going on here. The worst thing you can do is put your head in the sand. Oh, it's in America, it won't affect us. Trust me, it will have a monumental impact on our market.
Sure.
Geopolitical events that affect our mining, so there's a whole bunch of stuff that will go on there. So you can't bury your head in the sand. And if your advisor, if your current advisor is saying to you, oh, just ride this out, markets always recover, you need to upgrade to an advisor that's more skilled.
Sure.
Because they're not doing the right thing by you by not allowing you to protect your hard-earned money by putting some insurance or protection in play. And I know I'm so dogmatic in that view to people. There are a lot of very poor quality advisors that simply get paid a fee of a trail of funds under management. The more money you leave with them, the more they make. Don't they just leave the money there? We see this with clients we get all the time.
All the time.
You must be proactive in this case because this has got the capacity to be a real shakeout.
Yeah.
And buying insurance is not that hard. There's a process involved, but it's not that hard. But it's something you probably should have been doing at least a week ago, and your advisor should have been telling you to do that.
Yeah, it's absolutely great advice, and I think the whole key message there is to have more strings to your bow because this is a special situation. There's plenty of money to be made there if you do capitalize it. We teach that through our advanced options program particularly. The last question I want to ask you, AB, as we do come to the final parts of the broadcast, what are the key things to avoid? We've talked about what to do, what not to do. Now we've talked about leaving, that's kind of the obvious one. Is there anything else that you would suggest we don't do?
Yeah.
Big question, I know it's quite loaded.
Depending on your motivation, if you've got a really healthy ego, and I guess that's where it's coming from us too, but if you've got a really healthy ego, this is not the time to have big balls and have a point to prove and go, I'm going to take the punt and I'm either going to make a fortune or lose a fortune because you're going to be either absolutely right or absolutely wrong. And punting, that's not what this is about. That's the casino's job. Okay, I think you need to be more measured in that. So I think, doing nothing is about the worst thing you can do right now. And being too aggressive and too one-eyed about what's likely to happen, I think could also, you go all in on a bearish market and you see, a landslide victory for Donald Trump, you're going to see equity markets pump back up pretty quickly and you're going to lose a lot of money by being short. Likewise, if you think, and Joe Biden gets in, and you've got long positions there, you're going to see those hurt on the market's reaction to the uncertainty of a different administration.
Sure.
So, that's 50-50. I don't like those odds. I want to play the odds a bit more sensibly than that. So protection on the long positions if you don't want to sell them. Secondly, that volatility exposure, because there will be volatility, there's no question already seeing it. And then if you do want to have some work around the fringes on a directional play, then use some smart derivative strategy to do that. Yeah, okay. That will be a hard play. I wouldn't go all in on this, and I most certainly wouldn't be doing nothing and hoping, there's not an election on Tuesday. Just hoping,
Yeah, gotcha. No, it makes total sense. And look, we are coming to the end of the broadcast, AB. There's plenty to unpack in there. So how do our listeners or viewers actually get a hold of what you've got here and learn about it?
But we've done a few Facebook Lives recently. Come and check out one of our webinars and we can explain a little bit more about how this strategy works. Don't think it's going to be over your head. Don't think you've got to have piles of money. Don't think you've got to have experience as an investor or trader. Come in with an open mind and let us show you a pathway that's time tested. It's a very robust strategy that we run and it's been time tested over nearly 45 years. It's a strong strategy. And this is about little and often income generation, which in the current market is probably more important than anything. There are a lot of gurus out there that are going to teach you this, that, and the other. We've been in this space for a long time. I'm coming up for 29 years in markets now, and the playbook we've got is thick, it's well thumbed, and it's based on real experience. And elections happen every 4 years, and we've had strategy during my career. Now this is the seventh presidential election. In which case, let's look at what we used to trade through those previous ones and how they worked. So, there's no accident that we're going to get a result. There's no accident why we're up heavily already on our positions. And this isn't about bragging rights, it's about being proactive. So please don't bury your head in the sand. Find out more about this, be open, because money only flows to people that are open and people that are teachable. And if you think you know everything and you've got your arms folded, you're going to get one heck of a shot. I've been in this space a long time and I certainly don't know everything. I know I don't know everything. but I do know what I need to do in these conditions, and I'm making money from it, and so do our clients.
Success leaves clues, and that's great advice. Thanks very much, AB. How to position your portfolio throughout this presidential election, and there may be the rate cut as well from the RBA. Great advice. Thank you so much. It's been a pleasure.
My pleasure, and the voice just about held up. Good stuff. Thanks, Mitch. Well, there you have it, guys. Make sure you subscribe and like this. Better yet, put some comments below what you'd like to see covered, and if you want to follow what we do, hit the bell button above to be kept on notice as to what's coming up next. We look forward to helping you on your investing journey.